A very good afternoon, ladies and gentlemen. Thank you very much for joining today's webinar, organized together with the Ceylon Chamber of Commerce and Sri Lanka Accounting and Auditing Standards Monitoring Board. The key objective of this webinar is to share knowledge under the theme of general findings of accounting and auditing regulator. We have a very eminent panel here today. We have two speakers from the Sri Lanka Accounting and Auditing Standards Monitoring Board. We have Ms. Monita Bandara, Director Technical, Ms. Lakmali Hevage, Director Technical, and we also have Mr. Rajit Pereira, Partner of E&Y, and Ms. Hiranti Fonseca, Partner of E&Y. And today's session will be moderated by Mr. Suren Rajakarya, Partner Head of Audit at KPMG. Before I hand over the proceedings to Suren, I wish to kindly request all of the participants to please keep your microphones on mute, as well as your camera switched on, unless you're a panelist. And if you do have any questions, please use the chat box to send in your questions, where we will be taking it up during the Q&A session at the end of our panel discussion. So thank you very much again for joining in, and I would like to now invite Suren to take over the discussion. Thank you very much.
Thank you, Amanda. I hope it's clear. So let's start off the sessions as planned. First, two presentations on challenges faced in implementing some of the important accounting standards, and then the next two presentations will be on the accounting and monitoring board's findings. So without taking too much of time, let me first ask Rajit to share his screen and start the presentation, and then automatically we could have Hiranti after that, Monita and Lakmali to follow, and then we will have the panel discussion at the end of the session, at which time we will take on all your chats or questions on the chat box. Thank you.
Rajit, your microphone is on mute.
Sorry, Amanda, about it. So thank you, Suren, for that introduction. The objective of this session is to share our experiences relating to some of the accounting standards which are itself complex, and especially when you put it to the environment that we are facing today, it makes it further complicated to apply some of these principles, and there may be certain confusions that are arising as a result of some of those principles that are being discussed in the accounting standards. So that's why we thought we'll share our experiences relating to some of the key areas. I will be taking you all through some of those challenges relating to fair value measurement and financial instruments within about a 20-minute span of time. So I'm not going to go into the principles or discuss the principles of the standard, but rather I'm trying to highlight some of the challenges when you apply these standards in the given context. So I think there's no need of introduction to the pandemic, or because you and I have sufficiently experienced the effect that it has caused to the economic and the business landscape. So when you do talk about some of the implications arising to financial markets, the fair value is one of the important topics that we need to discuss. Because if you recall a few months earlier that Sri Lanka, we faced quite a number of challenges due to the fair value measurement, one being our financial markets not active during certain periods of time of the lockdown, which caused challenges to entities as to how you need to determine the fair value of some of those instruments. So let me quickly glance through the requirements of the standard and how you need to cater to some of those complex situations. The objective of the standard is to allow the entities to report a fair value of a transaction in an orderly market. So when you say orderly market, there are a few conditions that you will have to satisfy. There has to be willing buyers and sellers. You need to give its own time to allow the transaction to take place. In other words, the standard is not looking at a distressed market. So the question is, in a volatile environment, do we have all of these criteria being met when you try to determine the fair value of a particular transaction? Specifically, if you take a Colombo Stock Exchange, for example. So the guidance which is given in the standard is initially you need to look for a quoted price in active market. If your a particular instrument is listed in a particular exchange, for example, in Colombo Stock Exchange, you're required to look at the quoted price in an active market. So standard defines what is an active market and what is an inactive market. So active market has to have volumes of transaction. It needs to have a reasonable spread between your bid and the ask price. And they need to have market new entrants in a normal, ordinary manner. You need to have the market new entrants with sufficient market liquidity. So once you satisfy those conditions, you generally have an active market. So the next question is, can you get a blanket approval on the market to say the market is active and consider all instruments that are listed in the market to be reflecting active prices or fair market values for those instruments? That's a difficult question to answer because you cannot get a blanket approval for the entire market to say the entire market is active. Therefore, the companies which are listed in the market reflects the fair market value, because the objective of the standard is the evaluation has to happen at the transaction level, at the instrument level. So there could be instances where the market is active, but there are certain instruments which are not active. So if you don't have an active market, you're unable to refer the level 1 price. So when I say the level 1 price is the quoted price in active market. So then you are required to deviate from level 1 to level 2. So level 2 is where you're required to bring in observable inputs combined with the active market price, and then you try to arrive at an adjusted fair market value. So the difference between the level 1 and level 2 is, if you have an active market, you simply take the share price which is quoted in the stock exchange. But if you don't have an active market, you're bringing in observable inputs such as your price to earnings ratio. It could be your price to book value ratio. It could be your interest rates or yield curve. And you combine adjustments to your quoted prices to arrive at your market value, which we call level 2. If the level 2 is also not able, so it means you can't find any observable inputs, then obviously you will have to shift to a level 3 valuation. So that's the hierarchy in which that you will have to determine the fair value for financial assets or a financial liability. Specifically during volatile periods, these could be some of the challenging areas that you will have to answer yourself. Then the valuation techniques. How do we use valuation techniques? So if you don't have level 1, because if you have level 1, your answer is very straightforward. Simply you borrow that price and you determine the fair value for accounting purposes. But if you don't have level 1, then you have to go to level 2 or level 3. So how do you change this valuation technique? Are you permitted to change this valuation technique is the next question most of the time you will have to answer yourself. Shift between levels is permitted. You are required to shift from level 1 to level 2 if your active markets are not available. So it means there's no blanket rule to say every reporting date you have to use level 1 prices, because if the active market is not there, it's mandatory that you have to shift to level 2. So shifting between levels are permitted, and also changing between valuation methods due to unavailability of information, due to lack of clarity in the active market is also permitted. So which valuation method you are using is going to be a significant estimate that you're going to use in your financial reporting purpose, which you're required to disclose to your readers. So you're permitted to select a particular valuation technique, and you're required to disclose the valuation technique with key estimates that you're using to determine these values. And most importantly, each of these estimates required to be shown with a sensitivity as well. If any of your estimates increase or decrease, how it impacts your ultimate value that you have reported, and how it impacts your profitability. All of that will have to be disclosed. The questions that you will have to possibly prepare yourselves if we get into a volatile market, because you all will agree with me, the markets that we are in are not constant, they are very volatile. So if you're getting into a volatile market, always we need to keep our governance prepared to answer some of these questions, whether the share prices listed in Colombo Stock Exchange, whether it reflects the active market or the fair market value at each reporting date. If it doesn't meet the fair market value, how do you arrive at your fair market values at the reporting date? Whether you're going to use level 2 or level 3, what are the significant inputs? Which disclosures are you going to make available to the readers, are some of the important aspects that you will have to keep in mind. So then moving on to the next area, which relates to financial instruments, I will be not talking about the entire standard, because obviously I will not have enough time to do justice to talk about in detail some of the areas of the standard. So I'm picking up areas which we feel more relevant and appropriate to the audience. So I'm going to talk about the expected credit loss model, where we feel there's a lot of judgment, there's a lot of ambiguity and complexity coming in when you're trying to formulate the provisions, specifically under conditions where the entire economy is slowed down, where you're unable to get your best estimates and predict your expected losses. So that's where I feel few guidance required to be given in terms of sharing experience. And most importantly, when you try to estimate your expected credit losses, it's important that you look at the risk categories of your financial assets. Most importantly, an entity having trade debtors versus a company or a bank which is exposed to the risk of credit risk of loans and advances. Different risks can be there depending on the different types of geographical locations. So as we speak, there are certain parts of the country is under curfew. So the risks which are inherent in those regions, the risks which are inherent in the geographical concentration will have to be factored in when you predict your expected credit losses. In other words, you can't put all your debtors together and assess for expected credit loss, because chances are you will not arrive at your best estimates. So geographical concentration is one. The second one is the industry concentration. That's also very important, because of the pandemic, we have understood that the impact on certain industries are different. Certain sectors will have minimum stress, certain sectors will have medium stress, and certain sectors will have long-term stress. And also be mindful, some of these industries will also shift between coordinates, because this is one of the analyses that we did initially. Actually, there's a health warning on this. These are not the current analysis. These are one that we did towards the month of early May, latter part of April. So we initially felt that apparel sector would have to suffer a severe stress, because it might be a long period to recover from the current condition. However, within about few months, actually apparel sector bounced back quite fast. But unfortunately, again, the second wave has come in from a different aspect, which can result some of these industries to change their coordinates. From the present information, it's quite visible that the aviation, tourism and leisure likely to take a very long period of time to recover. When I say very long period of time, it can take more than 1 year or more than 2 years. So this could demand you to look at your trade receivables or loans and advances based on different risk characteristics. So you cannot put all of these different risks together. Rather, you need to segment it, you need to isolate it and assess for expected credit losses. So that's very important. So the industries which have a higher stress, a larger tendency of risk, you're required to isolate that and apply additional adjustments to provisions. Possibly one way of adjusting your provisions is through putting macroeconomic adjustments under different stress situations. So obviously, you are required to predict your macroeconomic scenarios when you try to arrive at your expected credit losses. One way of bringing that adjustment is you can bring in additional weightage for worst case economic outlook, because one of the anticipation or one of the predictions the pandemic, the economy is likely to slow down within the next 12 to 24 months. So you can build in assumptions to increase the worst case scenario and lower the best case and the base case scenario, which will automatically build in estimates to say your expected credit losses within the next 12 to 24 months are likely to be adverse in certain sectors. So you cannot put all your debtors together and do these adjustments, because then what will happen, your lower performing segment too will be impacted together with the underperforming segment. So that's why you need to have the segmentation in place, get your estimates right in terms of building some of these macroeconomic variables. Then moving on to some of the other current implications that you might have in relation to financial asset impairment is the recent downgrade of the sovereign made by one of the rating agencies, where currently the sovereign rating is being downgraded to CAA1, which is equivalent to a triple C rating of the country. So that too can have a financial reporting implication, specifically relating to some of the sovereign bonds which are in issue, including SLDB bonds, due to the expected credit losses estimate. So we just did a rough calculation that due to this downgrade, resulted from B minus to triple C, there's an additional 5% delta probability of default being applied to the sovereign bonds and SLDB bonds, resulting in a $0.01 impairment for every $1 a bond which is currently holding by institutions. So that's also a challenge resulted due to the current economic environment. So you might want to be aware of some of these changes that are happening, specifically in a situation where one rating agency have downgraded, which is the Moody's have downgraded to triple C, and the other rating agency have not downgraded the country. So there are questions as to what way in which that you need to think. Can you consider the rating of Fitch, which is B minus, for the expected credit loss assessment, without using the triple C rating, which was the rating equivalent to Moody's, which was downgraded recently. So these are some of the decision making that you will have to do when you're trying to prepare yourself for the financial statement closure process. So with that, I'll move on to an important aspects on the financial instruments, that is specifically relating to disclosures. So disclosures are quite important, because you would have felt even from the impairment standpoint, you will have to identify different risk characteristics. You're required to identify different segments of risk to high, medium, and low. You need to derive separate estimates to build up macroeconomic scenarios to calculate the expected credit losses. So the judgments, the estimates, the assumptions that you're using under each of these scenarios will require to be disclosed with their respective sensitivities. And most importantly, the segmentation or the portfolio segmentation that you're using will have to be revisited with reasonable time periods. So you cannot have a constant segmentation right throughout the period. Instead, you're required to revisit your segmentation from time to time. With regard to the contract modification, it's another important area which is resulting from the pandemic. So the contract modification actually leads to, if any of your organization change terms of financial instruments due to the financial difficulties of counterparties. You may give extended credit periods. You may give extended settlement plans. So if any of those conditions do exist, you're required to treat those contract modifications in line with SLFRS 9 and evaluate whether the modification is substantial. If the modification is substantial, you're required to de-recognize the contract and recognize the new financial asset or the liability. If the modification is not substantial, you're required to recognize the day one loss which is arising as a result of this modification and recognize that day one loss immediately in your P&L. So the question as to whether it is substantial or not, you're required to do the 10% test, which we have discussed earlier as well in multiple forums and discussion events. So if this modification is to be evaluated whether substantial or not, you're required to adjust your revised cash flows of the contract and discount it at the original interest rate. The present value, you have to compare it with the carrying value of the instrument to see whether the difference is greater than 10%. If the difference is greater than 10%, you define that as a substantial modification and you de-recognize the contract. But if the difference is less than 10%, you conclude that the modification is not substantial. Therefore, the day one difference you recognize upfront in your P&L. So that's resulting for contract modifications that are likely to happen if you are to extend terms or payment plans to any of your counterparties due to the financial difficulties or the external economic environment. So with that, we come to the end of the first session. I know it's quite a fast one, which we have to cover within about 20 minutes of time, but if you have any questions, I'm happy to take them and go into detail during the Q&A session. So with that, I'll hand over the proceedings to Hiranti, where she will take you to the rest of the remaining topics.
Hello, did we lose the connection somewhere? Okay.
Hi, everyone. Good afternoon. I'm waiting for the slides to come on. I will be taking you all through a topic, impairment, from a perspective of how this standard has become challenging since we've started experiencing COVID from the beginning of this year. And when we talk about impairment, there is also another standard, events after the reporting date, which I am compelled to touch upon because applying impairment becomes difficult when you look at some of the concepts in events after reporting date. I believe even when you try to apply fair value, a topic which Rajit spoke of, because of the situation that we are in when preparing financial reports, events after reporting date becomes a critical standard to properly apply judgment and perform the estimation process in most areas. So therefore, I will very briefly touch on events after reporting date also to bring more clarity into the difficulty in performing impairment assessment under the current environment. Right. Again, like Rajit, I will not go into a lot of technicalities, but I will touch on the standard and then try to bring in practical aspects of how applying the standard has become challenging under the current circumstances. So, LKAS 36 is meant to prescribe procedures to ensure that assets are not recorded at a higher value than what can be recovered by the entity. So in all of our balance sheets, we have assets and liabilities. And when it comes to assets, the most important factor is whether this asset can be recovered or not. And to a user of financial statements, when we present an asset on the balance sheet, the story that it depicts is this amount is recoverable in the future in the form of economic benefits. And if that amount, let's say you have an asset worth 100 million, if that 100 million cannot be recovered in the future, this standard tells you, LKAS 36 tells you, you need to impair that asset because it cannot be recovered in the future. And the standard also says recovery can be either by selling the asset or by using that asset in your business. So that is the objective and the expectation of the standard. Now, looking at our environment, this standard gets triggered because of various environmental issues that we face under the current context. Some of our officers, some of our operations are under restricted mode. Some of it may be closed down, some of it may be under restricted mode when it comes to business. Then almost all, well, certain segments, certain industries in Sri Lanka may not be experiencing it, but we see a lot of industries, especially like tourism, travels, etc., experiencing significant reduction in revenue. Some properties, some segments are experiencing nil revenue. Then, of course, we have various other challenges in performing business because maybe sometimes our customer base has changed, the way that we do our business has changed, etc. So, with all of these, poses us a question: are the assets on our balance sheet properly stated? Can they be recovered at the value that is stated on our balance sheet? So that is why impairment of non-financial assets has become a significant accounting issue since COVID-19 came into being. I also said that I would like to touch on another standard, which is events after the reporting period, because applying impairment will require you to have some knowledge of this standard as well. So what does events after reporting period tell you? You have your balance sheet date, and then there is a time period until your financial statements are authorized for issue. And during this period, from your balance sheet date to the authorized date for financial statements, various events take place. Some of these events can give us more information about conditions that existed on or before the balance sheet date. So, if there are events that have taken place after the balance sheet date, that give additional information about conditions that were there as of the balance sheet date. Those are typically adjusting events, meaning you need to adjust such events to an estimate that prevailed on the balance sheet date. I'll explain this to you with an example as we go along. Then certain events, and these events could be material also, can crop up during this period, which does not give any additional information about conditions that prevailed as of the balance sheet date. Those, even though they are material, will become disclosures in your financial statements. So the challenge actually is the events that crop up during the period from balance sheet date to the authorization of financial statements. It becomes very, very critical to determine whether they are adjusting or non-adjusting. And this is a debate that auditors, and I'm sure the regulators, will also have with all of you all when it comes to concepts like impairment, fair value measurement, and maybe other estimates as well. Again, the reason I brought this up is we've experienced that this is one of the main issues when performing the impairment computation. Do you consider these events that have happened? Is it relating to what exists as of the balance sheet date? And if so, how do we do the adjustments without overemphasizing on events that are not related to events that were there as of the balance sheet date? Right. When it comes to impairment, another point that I want to get across to you is it relates to non-financial assets. Specifically, you must go through the exclusion list in the standard because we get so many queries about how do we apply impairment LKAS 36 to inventories or certain other assets. But I want to highlight at this point, I won't go through this list, but just to make you aware that there are specific exclusions in LKAS 36 like inventories, certain assets arising from SLFRS 15, financial assets. These are scoped out of LKAS 36 impairment assessment. So please don't include them when you are doing your impairment assessment. Right. When you are performing an impairment, the standard says you need to look for indicators of impairment. Pre-COVID, a lot of us used to happily say that there are no indicators of impairment for my entity, my industry. Therefore, we don't need to do an impairment test, or we don't need to do further testing and do a computation to showcase that we do not have impairment. But unfortunately, under the current circumstances, I would think taking such a stance would be very, very difficult for entities. Unless you are in a very unique organization where you're experiencing phenomenal business opportunities, it will be very difficult for you to say that you do not have indicators of impairment. And in my mind, even if you do take that stance, you must remember once we get through this challenge of COVID-19, I think we would still not know what the environment would be. Meaning, how would businesses continue to operate? How will our customer behavior change? And mind you, these things are expected to change dramatically. So therefore, a lot of our business models that we currently have will undergo severe challenges. Currently, as we speak, we are still facing the challenge of COVID-19, and we are trying to figure out how we need to sort of put stop gaps and move on with our day-to-day lives. But hopefully, in the near future, once we get a hang of things, we will need to settle down and get back to some sort of a normal. And that situation or that environment is expected to be very different to what we are experiencing today. So obviously our business models, our strategies, the way we do business, our customer bases, our channels will drastically change as a result of this new environment. So therefore, even if we say, okay, my business is thriving right now, whether that business model is going to hold after 2 years, 3 years, is something that you need to estimate even at this point. So short-term business increases, opportunities may not last in the long run. Therefore, an entity that takes up the position that I don't need to do an impairment test need to be very, very thorough with that decision. Right. So key stages of doing an impairment would be, first of all, to assess whether you need to perform an impairment, whether indicators are present, and if yes, you need to measure the asset's recoverable amount. And then if you determine that impairment is present, you need to recognize it in your financial statements and perform the relevant disclosures. Now, when you are determining the recoverable amount of the asset, in LKAS 36, there are two concepts where you need to look at the recoverability of an asset, or you need to look at the cash generating unit. Cash generating unit is a bit of a technical concept, so I'm not planning to cover it during this session, but that is another principle that needs to be looked at during impairment on how you need to club your assets or group your assets. Once you so for simplicity sake, I will use the word asset moving forward instead of CGU. So an organization must determine the higher of the fair value less cost to sell of that asset or group of assets, or value in use. That is, first one is quite straightforward. That is, you have to get, if you are to sell this asset, what is the price that it would fetch under the principles that Rajit mentioned, that is fair value. The second option is you perform a value in use test. That is, you are not expected to sell this asset, but you are expecting to use it in your business. Therefore, what are the cash flows, the future cash flows that this asset or group of assets would bring in to the organization? So you would look at cash inflows and the outflows, and the net of it will be discounted to today's terms. So in very simple terms, that is what a VIU or value in use computation is. And the standard, being very generous, allows you to take the higher of these two amounts. So if you get a fair value less cost to sell, that is the fair value of the asset is higher, it allows you to compare that amount with the cost that is in your books. Or if the value in use gives you a higher amount, it allows you to compare that with the cost that is in your balance sheet. And if there is no impairment, you are good to go. But if the value in use is less, then the impairment will be recorded. Now, sitting here and telling this is how you need to estimate your cash flows, the inflows and the outflows, sounds very simple, but I know it is quite challenging. Now, someone else has taken control of the screen, Danushka, I believe. I would please request you to give the control of the slides back to me. Okay, thank you. All right. So let's talk about the challenges in doing such a VIU computation, because as I said, fair value was already discussed by Rajit, so I'm not going to go into details about that. Maybe we can have a few questions on that when we go into the panel discussion. But in terms of the value in use computation, this has become one of the most discussed topics with companies because it has become very challenging. Especially there are certain industries where estimation of cash flows has become very challenging, because as I said, they really don't know after 1 year or after 2 years what their business model is going to be. So how do they estimate these cash flows, right? So a value in use computation has several elements. One is what are the cash flows expected to derive from this asset. Then you have the expectations about the possible variations in the amounts of these cash flows. This is where a lot of judgment comes into play, and you all would agree with me when I say the conditions that we are going through right now are unprecedented. That means we have not experienced this kind of a situation in our lifetimes before. So in such a situation, we don't even sometimes have the history to come up with what the variation of these cash flows should be. So it makes it that much more complex to come up with estimated cash flows. Then time value of money. Time value of money, that is the discount rate, has always been a much debated topic when it comes to value in use and so many other areas in the accounting standards when we use a discount rate. But in the impairment, when it comes to impairment, again, there are so many questions as to what is the time value of money that we should be using, what is the discount rate we should be using, how should we adjust this, what are the risks that can be considered in adjusting the discount rate, and is the discount rate that is available based on market information, is that reasonable for us to take? So these are some of the questions that have come up when doing impairment computations. Then of course the standard asks you to account for various other uncertainties and risk factors in your cash flows. This is a very high level example of how an impairment or a cash flow estimate would be done under circumstances. So previously we may have done a cash flow estimate.
Hiranti, sorry.
I'm running out of time, is it?
The slides are moving differently, Hiranti. It's on the LKAS 36. Your second slide is on. Can you try and get to that your example slide, please?
I'm sorry, because there is another person who has taken control of the slides.
Yeah, it keeps moving up and down. I've noticed it as well. I think is it Danush? Guess.
Yes, yes.
Yeah, that,
Okay, so I am on the slide of the example.
yeah, but
Is
we
it
can't
visible to
see
you
the
now?
slide. Yeah, we are on the your second slide, like LKAS 36 exemptions, exclusions.
Now can you see it, Suren?
No, no. I think still you're not in control of the slides. Cannot. Okay, now it's identifying impairment.
Oh dear.
Uh,
Because the slide that I'm looking at is
different.
13. Yes.
Yeah, yeah, yeah. But what is on the screen shared is different. Unless you now how do we get back? Amanda, can you help from the host can help, I think. Who's hosting from the chamber side? Can you take control and then give it back to Hiranti? No, it's not moving.
Kiran, can you reshare the slide again if you pull it
Yeah.
out again?
Okay.
Yeah.
Now
Key stages in impairment.
now is it okay, Suren?
You're on key stages in the impairment process?
No, no, I'm on the example. So I'm trying to
8, I think. You're on, I mean, we need to move to about slide 14 or 13, right? It's
yes,
not.
that's right.
Okay, okay. Now is okay.
Now is it okay?
Okay, I have got control. Now I'm on slide 13.
All right.
Forecasted cash flows. Okay, continue. Yeah.
Yes, example
No,
is the topic.
excuse me, Hiranti. For us, still the slide 8.
Oh,
Ah. Oh.
Now okay. Now okay.
Right.
is everyone else okay?
Yeah, now we are fine, Hiranti.
So, Suren, you have control, right?
No, now I have.
Yeah, that's all right. You keep control. I'll tell you when to move the slide.
Now I have. Now the slide has gone out of mine.
Yeah. We
Yeah,
can't see the slides now.
Yeah, no slides. That's what I'm thinking.
Okay. So let me try and
It's
get
with
the
you,
slides back. Okay, give me a second. You should be able to see it soon.
Okay, it's coming on, I think.
Yes.
Yeah. Okay. Right.
Okay.
30. Yeah, fine. Thank you.
Thank you. Sorry about that, everyone. Try not to meddle with the buttons on your screen. What I was trying to showcase to the audience was an example of a cash flow of how you will need to estimate the cash flows to test for impairment. Previously, we would have been happy with projecting 5 years of cash flows for a particular company, for the particular group of assets, the inflows and the outflows, and arriving at a discount rate. But as I keep mentioning, the environment is so volatile, you may not be able to take one scenario to predict cash flows. So the standard allows us to predict various scenarios and take a cumulative approach on the impairment computation. So in this example, what I have shown you is a company has projected cash flows for 5 years, and they have applied probabilities based on best case 50%, base case 50%, best 25, worst 25. That is, they are expecting various scenarios to affect these cash flows, and that is allowed in the standard, and that is a more common approach applied by clients to arrive at the VIU for your assets nowadays. Also, you would see a terminal value being applied after 5 years. That is, at the end of 5 years, you say that your cash flows are at a constant growth or declining growth, and take the terminal value based on the life of your assets. Now, I heard that in some of the other countries, certain industries, certain companies are taking this terminal value much higher than the 5th year. So typically we would take the terminal value at the 5th year or 7th year, because we would forecast revenue for 5 years or 7 years. But I heard that sometimes, because of the volatility that we are going through, the terminal value may come in even after the 2nd year or the 3rd year. So again, options that you all can consider if estimating cash flows is very challenging in your organization. Of course, your auditors and the regulator will also have to sort of be comfortable with some of these changes or the estimates that you are doing. Okay, so that brings me to the end of my session. I would like to leave you with two key things that we must keep in mind. And I mentioned this over and over during my presentation. That is, we are living in unprecedented times, and applying accounting standards therefore has become that much more judgmental and complex. So we need to keep this in mind when we are looking at estimation process especially. So with that, I will hand you over to Monica, who will take over the session in terms of sharing with you accounting issues that she has experienced as a regulator.
Can everyone see the slides properly?
Yes, okay, Monita, please proceed.
Yeah. Hi everyone. Good afternoon. I am Monita Bandara from Sri Lanka Accounting Standards Monitoring Board. Myself and Lakmali will be discussing of the findings we have observed during our inspections relating to accounting and auditing. Before moving to findings, I would like to give a brief introduction of Sri Lanka Accounting and Auditing Standards Monitoring Board, SLASMB. SLASMB was established under the Act number 15 of 1995. It has two main functions. One is to monitor compliance with Sri Lanka accounting standards by specified business enterprises, and the other one is to monitor compliance with Sri Lanka auditing standard by the auditors of those specified business enterprises. These specified business enterprises, we call SPEs, have been identified by the Act. If I tell you the type of companies which are regulated, like listed companies, banks, insurance, finance, leasing businesses, factoring, and like that, and also the companies which are not regulated, those are mainly the privately held companies. If the criteria specified, there are certain thresholds specified. If those thresholds are met, then those are also identified as SBs. So how we monitor compliance with Sri Lanka accounting standard is by reviewing audited financial statements of those SBEs. And how we monitor compliance with Sri Lanka auditing standards is by inspecting the working papers of the auditors. So these are the main powers that SLAS MB has. It has power to require submission of audited financial statements of SB. So all the SBEs have to. Can you see the slides properly? Because hello.
Yes, we are on powers of monitoring.
Right. Okay. So powers of so all the specified business enterprises have to submit the audited financial statements to us, and also we can call for information from the from those companies and also from the auditors relating to the financial statements, and can carry out investigations, can summon any director, officer of the company, or auditors of those companies, and to take legal action on violation of the Act. So let's come to the findings. As I explained, we monitor compliance with Sri Lanka accounting standards by mainly reviewing financial statements of those companies. So during the review of financial statements, we have observed findings which can be categorized into different areas. So I will explain to you different types of findings that we have observed. This one is relating to fair value measurement, which is a very common area. I have given here some of the observations that we have made relating to the fair value measurement of properties. So the first one is not considering the restrictions on the sale or use of the asset. So restrictions can be legal or any other restriction. If the restriction is on the sale or use of the asset, that becomes a characteristic of the asset, and that is transferred to the buyer. So the buyer will not pay the same amount that he will pay for an asset that there is no restriction. So therefore, when there is a restriction for an asset, so there should be an adjustment coming into the fair value to reflect that restriction. So can give you an example where lands which are subject to legal cases, and those lands have been reflected in the financial statements as sometimes as PPE or sometimes as investment property. But these lands are subject to legal cases, and also there are restrictions on the sale or sometimes on the use of the land. But what we have normally seen is, without considering those, fair value is estimated based on the prices of similar land in the neighborhood without any adjustment for those restrictions. That is actually inappropriate when the principles of the SLFRS 13 is considered. The second one is on using prices of transactions with related parties when valuing the property. So related party transactions are normally not at arm's length. So those prices derived from those transactions may not be appropriate for the fair value measurement. So there is again example where a company had a huge land that part of that land was has been sold to a related company at a very higher price compared to the prices of the similar land in the lands in the neighborhood. So the balance extent was a property reflected in the asset reflected in the balance sheet, on the balance sheet, and that remaining extent has been valued using that higher prices, thereby huge gain has been taken to the financial statements again, which is again not appropriate and not in line with the principles of the standard. The third one is relating to lands again. Again, using prices of lands in the neighborhood without considering the characteristic of that particular land you are valuing. So characteristic include location and also the condition, sometimes conditions of the land. Without considering the conditions or maybe the location, just comparing the lands in that area, but when you really look at the value of the land that you are valuing, need an adjustment for the specific conditions that the land has. So the another one, next one is not evaluating results of multiple valuation techniques. So where multiple valuation techniques are used, standard requires the results to be evaluated. For example, we'll say 2 valuation techniques are used for the fair value determination, say market approach and fair value technique, present value technique, and the results of the 2 valuation techniques vary significantly. So we have seen instances where using the higher end value as the fair value, disregarding the results given by the other valuation technique. What SLFRS 13 says, when there is a range like that, you need to come to a point which is reasonable to determine the fair value. If the range is wider, you may have to do further analysis like revisiting the assumptions. Either one, probably the present value technique could be incorrect, the assumptions used could be incorrect, you need to revisit. So without doing that part, we have seen taking the higher end value as the fair value. That is also again a non-compliance of the standard. And the last one is about the disclosures, description of about the valuation technique, and also the inputs used in the fair value estimates. Those are actually very important for the reader to understand how the management has decided the fair value. And also in measuring the fair value, in most of the cases companies get the service of valuers, professional valuers, to determine the valuation. But that value is finally reflected in the balance sheet as the fair value. So therefore, management has to make sure that the value determined by the valuer is in line with the principles of SLFRS 13, because these have to be determined for the purpose of financial reporting, and finally this is reflected in the financial statement, in the sense management is finally responsible for the financial statements even though the values are given by the valuer. So I will move into the next area relating to financial instruments. There again I have taken here few findings. One is reflecting preference shares that have liability features as equity. This is actually a very common issue that we are observing even now. Preference shares, always, most of the cases, those are reflected as equity without further looking at the terms attached to those preference shares. So sometimes if you carefully analyze preference shares terms, based on the terms of these shares, it may be it has to be classified as a liability, or sometimes there may be liability features as well as equity features, in which case you need to separate. So but without analyzing that, we have seen so many cases where preference shares have been reflected as equity. The other one is where this is related to fair value measurement of unquoted equity instrument. To value the fair value of this unquoted equity instrument, the company has used issue price of preference shares issued by the same issuer who has issued the equity instrument, that is the investee company. The company has used the issue price of preference shares which has liability features without any adjustment to measure the fair value of the equity instrument, which is again not correct. So the others, under impairment, next one is on impairment. There are few, most of them are relating to the actually finance companies. First one is not capturing historical loss experience when estimating the impairment figure. So, for example, deemed losses. So you have long overdue receivables. You can't expect any cash flows, but those loss contracts have not been considered in their loss rates, final loss rates, and also some written offs have not been considered. And also the second one actually relating to individual impairment, where uh, there are some long overdue receivables. Sometimes those are long outstanding for more than 2 years, as at the year end. But from the next month onwards, the companies are expecting regular cash flows, as they will pay regularly. Without any justification, we have seen that they are taking some cash flows, future cash flows, and thereby avoiding recognizing of impairment or sometimes understating the impairment. And third one is relating to incorrect computation of time value. Actually, even we have seen formula errors, which result significant adjustments to impairment, and also sometimes on renegotiation of loans, sometimes the companies, finance companies or banks, they freeze the interest. So in that case, the system shows the zero rate interest, and in computing the present value also, they have taken the zero rate rather than taking the effective interest rate. In that case, there won't be time value computation in that. So that again incorrect. So the last one is not actually relating to finance companies. Those are mainly relating to private companies, where we have seen related party receivables, sometimes which are long out, those are long outstanding, but they have not even assessed for these receivables for impairment. Last one is related to disclosures, disclosure of the credit quality. There are so many disclosures that a company has to make, provide in the financial statements, but though we have seen so many lapses relating to credit quality disclosures. The other area is relating to LKAS 36, impairment of assets, what Hiranti discussed. Most common issue there we have seen is the first one. That is the non-recognition of impairment, or sometimes understatement of impairment when impairment adjustment is necessary. For example, goodwill from and investments in loss-making subsidiaries. What we have seen basically, most of the cases, for the value in use computation, they do the projections. For these projections, companies have used abnormally higher growth rates, and ultimately what has happened, there is no impairment, but actually if you look at the companies are not making profits. In the history, there are no you can see the companies have made profits, and also there are no committed plans or different strategies. So without having justifications, they have taken abnormally higher growth rates, and thereby understatement of impairment or sometimes not recognition of impairment have seen. And the second one is relating to disclosures. Sometimes we do not see the disclosure on what is the recoverable value, whether it is the fair value less cost of disposal or whether it is the value in use. So, and also on the assumptions. So disclosures are very, actually not enough disclosures are made sometimes in relation to the assumptions. These are some of the findings that we have observed relating to other areas. First one is relating to SLFRS 15 transitional adjustments. We have seen prior period error corrections relating to revenue have been included as part of the impact of adoption of SLFRS 15. So we have seen sometimes because of the adoption of new revenue standard, there is actually basically no impact to the company, but there is a huge amount shown in the disclosure as the impact of adoption of SLFRS 15 to see actually those are relating to prior period errors. So even we have seen the same thing when other standard also for the first time when they are adopting as the transitional adjustments, we have seen some prior period errors are also disclosing as the impact of adopting that new standard, which is not correct, because For prior period errors, there is a separate standard, that is LKAS 8. All the prior period errors have to be dealt with according to that standard, and disclosures have to be made in accordance with that standard. And the next one is relating to recognition of deferred tax asset for tax losses without assessing availability of future taxable profits. There again, what we have seen is using assumptions that are not reasonable. Sometimes companies project future taxable profits and assume that the tax losses that they have carried forward can be claimed against the taxable profits in the future. But when the projections are not based on reasonable assumptions, you can't just assume that tax losses can be claimed, and therefore deferred tax asset recognized will be reversed. Third one is relating to non-preparation of the consolidated financial statements when the exemptions given in the standard is not relevant. Last one is not making proper books, not maintaining proper books. Not maintaining proper books is actually a violation of the act. How we have seen this, sometimes auditors are not given the information that they required for the audit in the form that they require, because of not maintaining the information in that form. For example, those were like debtors age analysis, inventory age reports, which are those reports actually companies have to generally maintain, but due to unavailability of these records, auditors are not in a position to there is a scope limitation on their work, and they are not in a position to give a fair, in the sense true and fair opinion. There will be sometimes qualifications based on those. So those are the findings relating to review of financial statements. These are only few actually. Anyway, Lakmali will take you through the auditing aspects. Thank you very much.
Hi everyone. I'm going to take you through a slightly different topic. Hope everybody can hear me.
Yes, okay. Clear.
Okay, so audits. I know you all are familiar with the audits and auditors. After each year end, financial year end, the auditors come to your offices. They ask a lot of informations, explanation, and you believe they give you a bit of a tough time. But believe me, all that trouble is worth taking, because audit gives your financial statements credibility. Without that audit report attached to your financial statements, the people will be reluctant to trust the financial statements as to whether they will reflect the true status of the company. So the audited financial statements gives the credibility, and the stakeholders will trust more on your financial statements. Why I say stakeholders here? Normally, the auditors address their audit report to the shareholders of the company, who are the auditors, but who are the owners of the company. But shareholders are not the only party who's going to rely on the audited financial statements. There are some other stakeholders. For an example, we, being the accounting and auditing regulator, we trust on audited financial statements. There are banks, Inland Revenue, and various other parties who trust on audited financial statements. And there's another benefit of an audit. It will help a company to improve their internal controls and systems. Throughout the audit procedures, the auditors will detect some weaknesses or lapses in your control systems, and they will inform the management so that the management can take necessary steps to correct them. Remember, this is not the responsibility of the auditor. The responsibility of the internal controls and systems always lies with the company's management. Now we are going to discuss about the audit regulators. Audit is done according to auditing standards. Auditing standards are a set of standards that sets requirement according to which the auditor should conduct the audit. And there's a question whether the auditors follow these accounting standards, auditing standards or not. There, the role of the audit regulator is important. Audit regulator is there to monitor compliance with auditing standards by the auditor and thereby improve the audit quality. So if the audit is conducted in accordance with this set of auditing standards, it will be a good quality audit. Now, maintaining this good quality audit quality is not an easy task. Most of the audit firms, they put a lot of effort in maintaining audit quality. Some of them have dedicated person to look at the audit quality and improve the audit quality. Some of the auditors have dedicated divisions or departments with expertise knowledge to enhance and make sure that their auditors are doing a proper job. So which is very costly, I must tell you. So it's not an easy task. And remember, this improved audit quality enhances reliability of the financial statements, and again it enhances the stakeholders' confidence. Now we discussed audit quality is very important. Let's see what are the consequences of audit quality. I will take a simple example. There is the revenue figure in the financial statements. Your auditor may not perform any audit procedure on the revenue. They will not a single document. They will not test a single document on revenue, and still they can give you the opinion saying that the financial statements are true and fair. They did not check the revenue, means they have not checked the major part of your profits for the year. But still they say, they give their opinion as true and fair. They give a true and fair view on your financial statements. The people, owners or the management or the bank or anybody who's taking a decision based on those profit figure, there is a possibility that the decision could go wrong because there can be errors and misstatements in that revenue figure. So stakeholders always rely on financial statements. And if the audit quality is poor, they will be relying on a wrong set of financial statements. And remember, the poor audit quality will not help your company in improving their controls and systems. Now I will take you through an example for poor audit quality. What would be the consequences of a poor audit? First example, this is a finance company. They had 1.1 billion worth investment property on their balance sheet. As we discussed earlier, investment properties usually are carried at fair value. In this case also, this company carries investment properties at fair value. They have annually fair valued and taken the fair value gains to their profit. But the problem is these investment properties were lands and buildings occupied by some other people. And these occupants are not paying any rent and there are legal cases proceeding. The problem was in arriving at the valuation of the properties, the valuer or the management has not considered any of these restrictions to the valuation. If they have considered these restrictions, this 1.1 billion value will not be there on their financial statements. So accordingly, they have overstated the assets and overstated the profits as well. The second example, it's also a finance company where you all know that the finance companies, they test their loan portfolios for impairment, and the impairment amount is arrived at using an impairment model. This auditor of the finance company has not tested the impairment model adequately as to see whether it captures all the historical loss patterns. So when we checked it on our own, we realized that there should be approximately 270 million rupees of impairment additional provision has to be made in the financial statement. Accordingly, the company has overstated the assets and overstated the profits as well. So I took those two examples to make you understand how severe the consequences of poor audit quality could be. Now I will discuss about some audit inspection findings we commonly come across during the recent past. One is the auditor has not detected non-compliances with significant accounting standards. Those non-compliances were significant, but the auditor has not detected during their audit. And in some instances, now in arriving at the audit opinion, the auditor is supposed to gather audit evidence to back their audit opinion. But there are instances the auditors have not obtained sufficient appropriate level of audit evidence. For an example, there are big debtor balances, huge loan balances on their balance sheets. But sometimes the auditor calls for direct confirmations. Later on, they don't receive the confirmation. They are expecting the confirmation and they are not performing any other audit procedure. But if they do not receive the direct confirmation, then they have not obtained adequate amount of audit evidence to say that such a loan balance or such a debtor balance is true and fair. And there are some other instances where we have come across the auditor has not tested properly the accounting estimates made by the company. Accounting estimates include judgments and other inputs. I think these topics were discussed earlier in detail. They have not tested accounting estimates like fair values and impairments properly, and most importantly, there have been disclosure non-compliances as well. Now, this is a very important part of the audit: communication with those charged with governance. Those charged with governance is the board of directors and subcommittees of the board where appropriate. The auditor is supposed to communicate timely on certain matters. There is a separate auditing standard on this which gives guidance on how to maintain communication with those charged with governance, because it's a very important aspect for the audit to be effective. And there we have also come across instances where the auditor has failed to perform adequate audit procedures on risk assessment. They have not basically performed a proper risk assessment, including the fraud risk. Now, the risk assessment is the core of the audit, followed by the performing the audit procedures and giving the opinion. If the risk assessment itself is not proper, then that would be a wrong start to take. So remember, when you're selecting the auditor, pay attention to the whether the auditor is committed to maintain audit quality. With that, I conclude my presentation. Over to you, Suren.
Thank you. Thanks, Lakmali. I think we covered extensively a lot of areas. Thank you for all four presentations, for covering very important topics on challenges on financial reporting and the findings from the monitoring board. Some of the comments or the words which kept coming back or resonating with this presentation was challenges. Then Hiranti mentioned about unprecedented and estimates. We had judgments, assumptions, impairment, and fair value. All these are going to seem to be causing an issue in some form or the other. I don't see any questions on the chat yet. If there are any questions, please do post on the meeting chat on your right-hand corner of the screen, so that we can take them up. In the interest of time, let me also ask a couple of questions from our presenters in the meantime. So there seem to be all these challenges in terms of estimates and judgments and all that. Let me start off with Monita or Lakmali asking whether the as a regulator, auditing and accounting regulator, whether there is any consideration or you think these challenges can be reduced, or they are not real challenges, but they could be overcome very easily, or is there a realistic or sympathetic view towards inability to estimate or judge the accounting balances? What do you all think about the local market?
Actually, estimates have a lot of uncertainty. That's an element. It all depends on the past experience and the prediction of the future, which is not certain. Of course, there can be element of uncertainty, but the management will have to exercise proper judgment. There will not be any sympathetic or any other concession due to any reason, because the financial statements will have to reflect a true status of the affairs. So the management will have to exercise best judgment.
Realistically, yeah, that should be correct. So if I may post the other side of it to the presenters from EY, I mean Rajit or Hiranti. So we explained a lot of these procedures and said that each item should be identified, estimate should be, properly. You have a procedure for coming up with those numbers, modeling, all that. Why is there a significant challenge in terms of regulator finding so many issues? What do you think could be the fundamental issue or behavioral aspect in terms of financial reporting? Yeah,
Suren,
Rajit.
I'll take it up on the areas relating to financial instruments and fair value. I think Hiranti would probably add relating to impairment. The biggest challenge, I would think, the dynamic environment at the conventional accounting role was not that dynamic. So I would just take an example of a simple depreciation calculation. Whereas you do the same thing over and over again, accounting profession over a period had evolved from a static routine function to a function which is more dynamic, which requires you to factor in predictive analytics. Now, for example, the fair value, expected credit losses, even certain other standards such as share-based payments, employment benefits, requires you to look at the future, do some form of predictive analytics. So, which shifts the role of the accountant from conventional role to a more dynamic platform. So some of us have not identified the change properly, instead use or tend to use constant assumptions. So once we develop a model or build a model, we believe, or we tend to believe, it's foolproof. It won't change. But the reality is, as and when the environment is changing, the dynamics are changing, when you are going through uncertainties, you're required to factor the change of assumptions and recalibrate these models. I think that's where the regulator finds more findings compared to some of these complicated accounting standards.
Right.
I think Hiranti, want to add anything?
Hiranti, in addition, when you
what Rajit said is very much applicable to even impairment assessment, but to add on to what he said, another factor is from auditor's perspective and regulator's perspective, sometimes we come in post balance sheet, and there is this concept of hindsight, and we may be more privy to information that was not available at the time the client was preparing the accounts, and the regulator would come even after that. So it is sometimes with that hindsight, we sometimes question the client in terms of certain positions that they may have taken. So that also adds on to the complexity of this estimation process.
But that would be unfair, isn't it? That I would consider that unfair in terms of regulator questioning or the auditor questioning in terms, because hindsight reporting is not permitted. What is your view on that?
I also would like to add a point to the question you asked previously, the
Okay.
question you raised to Rajiv.
Yeah.
So sometimes what happens for estimations, especially for these fair value measurements and impairment assessments, most of the cases management relies on a work done by some other professional, maybe valuer or some other party, right? Then the management sometimes forgets that the responsibility to these estimates are with them, and sometimes they just, maybe I don't know whether due to lack of understanding or lack of expertise or for whatever reason, they just rely on the figures given by the other party. And also we have seen the instances where auditors do not challenge adequately, not all the cases, there were a few cases not challenging adequately. So those also may be some reasons why we are finding a lot of these type of issues relating to estimations.
Okay, there is a question on the chat. What are the important areas to be considered by internal auditors, board audit committees in relation to impairments process in banking financial industry due to impact of COVID-19? Since it's on impairment, shall I ask, can I ask Hiranti? Banking and finance would be, I think, Rajit, but among the two of you.
Yeah, I'll try to answer it from areas
Financial.
that financial institution perspective, the areas the governance needs to focus, specifically the risks of the portfolio, the credit risk. You need to understand, I think I covered this very briefly, the segmental risks of the portfolio, which is arising from different sectors, what is the exposure or the concentration to high risk sectors. That is a sectorial concentration, and then you have to have a very clear proactive strategy of monitoring, because I told you that during my session, some of these quadrants will change. Some of the high risk sectors will bounce back fast, and unexpectedly sometimes different sectors which we deem as low or moderate risk can be converted into a high risk segment because the external environment is that volatile. So you need to have a very clear monitoring process. In Sri Lanka, the biggest challenge that we see, we have a very good loan origination process. We go in to evaluate the credit risk of the customer. We look at the collateral. We look at the cash income earning potentials, check the crib. We do all of that. But once we grant, we generally take a backseat, because after we do the sanctioning, the monitoring, the post-sanctioning monitoring of the credit is moderate to weak in Sri Lanka. That's one of the reasons that we see there is exponential growth in NPLs over the last a few years, which the environment was challenging. There's exponential growth in NPLs. So the finance institutions require to deploy a very good monitoring strategy to understand the shifts of these risks, as well as a collection strategy. You need to know how to understand the pulse of your customer, how to deploy the collection strategies. Most of the institutions do have a standard collection strategy. It's a one size fit for all. You have after 3 or 4 days, you send a reminder, you do in writing letters, then you do a field visit, which is standard you do across all borrower levels. So which has to be more focused on different risk characteristics. So these are some of the important areas where financial services sector will have to change their strategy. Most importantly, you need to understand where you have to lend and how do you maintain that concentration. You need to understand where your profitable customer segments are. You understand which industries are more profitable, where you need to keep on lending money, and how you recover it through monitoring and deploying an effective collection strategy.
So the important areas to be considered by internal auditors and board audit committees would be in terms of having that monitoring process into this loan assessment process, isn't it? Internal audit has to get regularly involved in making sure that they evaluate all these controls and processes and procedures, and also board audit committee also should be involved in what shall we say, quarterly at least, reviewing these processes on an active basis.
Correct. Suren, just add on to that, probably there need to be new MIS reporting structures created, layers created to inform the board's audit committees, board integrated risk management committees of some of these information, because that information, new flow of information has to happen within the different governance structures.
So yeah, so they could identify what is additionally required and create maybe more reporting structures or dashboards to have the required information for monitoring, I think. Yeah. So monitoring by internal audit is also important. Whoever, I think Darshan has asked this question, whether it was due to COVID or not. COVID has made it more regular and more dynamic rather than before, I suppose. That might be the only change. Yeah, we are about 5 minutes or 6 minutes over time. Maybe since there are no other questions, I will just ask maybe one more in terms of you were talking about this involvement of valuers and consultants and all that. Lakmali was also referring to some of that. My general question is whether there is an apprehension by the head of finance in lots of the companies to use consultants or use other experts to evaluate whether it is impairment or financial instrument values or ECL or anything, because they think that the management might accuse them of not knowing or not being knowledgeable. Is there something like that which will affect the input at a professional level? What do you think?
Hi, Suren. I'll quickly add on my thoughts because I also need to leave the call.
Sure.
I think that's a very good question that you raised, Suren, and we have experienced it in the past. I must say that the CFO is reluctant to go to the board to say, look, I need an expert advice on this, because the board would ask him or her, why do I have you? Won't you know how to advise on this and take this forward? But what everyone must realize is the application of accounting standards, especially in the complex environment in which we are living in, is not easy. And some of the benefits of using a consultant or expert is they are able to then share the experience that they have, which a CFO of an organization would not be privy to. They can get the benefit of using industry experience, global experience in coming up with the best solutions, especially when it comes to using judgment and coming up with estimates. So with that, thank you, Suren, and I take your leave.
Okay.
See you.
Thanks. Thank you, Iranji, for the presentation. And Amanda, if there is no other questions, we could, I think we've covered the challenges and the practical sides of the presenter's experience in these comments. Can we wrap up the session if there are no other questions? Do you have any, Amanda?
Thank you, Suren. I think we don't have any more questions.
Okay.
But I'd like to invite all the participants to please be in touch with the chamber. If you do have any questions, we can follow it up through emails and send it across to the panelists. So please drop us an email if you do have any concerns to the email address events@chamber.lk, and we can get back to you with any clarifications. And the recording of this session, we will be uploading it onto YouTube, onto the Chamber Academy YouTube channel, and we will also share the link with you. So once again, I'd like to thank all the panelists, Suren for being the moderator for this webinar today, and Monita, Lakmali, Rajit, and Hiranti for your participation. at this webinar. It has been a very knowledgeable and a useful session. I'm sure the participants agree with me as well. And thank you again from the chamber. And I would like to also thank all the participants for being actively being part of this webinar. Thank you very much and have a good day.
Thank
Thank
you,
you,
everybody.
Amanda. Thank you,
Okay.
everyone.
Thank you.
Thank you.